This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Splitsville. Hewlett-Packard thinks two companies are better than one. But why is HP splitting now, and what do investors think of the move?
Taking the stand, Paulson, Geithner, Bernanke, familiar faces from the financial crisis in court this week, defending their actions in the bailout of AIG. Today, it was former Treasury Secretary Hank Paulson's turn.
Turn of events. One of Apple's suppliers surprised investors this morning by filing for bankruptcy. All that and more tonight on Nightly Business Report for Monday, October the 6th. Good evening, everybody. I'm Bill Griffith. Glad to be back. I'm in for Tyler Matheson tonight.
And I'm Susie Garrett. Good evening from me as well. The buzz on Wall Street today was about the big breakup at Hewlett-Packard. It's the second technology giant in the past week announcing plans to split the company in two after eBay. One of the new Hewlett-Packard companies will focus on its personal computers and printers. The other on the fast-growing corporate IT and technology services like data storage, servers, and software. Investors rushed in to buy HP stock, sending shares up nearly 5%. Josh Lipton has more on the reasons behind the split and what's ahead for the two companies.
Think internet scale with billions of users and devices.
Hewlett-Packard's CEO, Meg Whitman, used to argue that the company's business lines worked, in her words, better together. Not anymore. Now the company is splitting in two. One company, which is going to be called HP Inc., will be devoted to printers and personal computers. It will be led by Dion Weisler, who is an executive in that division. Whitman will lead the other company, which will be known as Hewlett Enterprise. It's dedicated to enterprise hardware, software, and services. Whitman says that the breakup creates two companies that can be more focused and agile in a rapidly changing marketplace.
Today is only possible because the turnaround has succeeded. Think about what we have accomplished over the last 3 years: a rebuilt balance sheet, an innovation pipeline that is significantly improved over 3 years ago. I would argue best in class in the industry now. An inspired workforce, a new leadership team, renewed confidence of our partners, our customers, frankly, our shareholders as well. But we had to gather ourselves as one HP. But now we're in the position to take advantage of what's going on in the marketplace and position these two companies for growth.
But there's another reason Whitman might have acted now. Recode, the tech news site, says HP tried to sell its PC division, but rivals such as Lenovo and Dell weren't interested. Investors cheered the news today. The stock is now up some 70% in just the past 12 months. Analysts who cover HP say the two companies could also be attractive takeover targets.
One of the things we wrote about this morning in our note is separating these two companies gives HP huge flexibility. EMC or someone else would never want to take on the enterprise, take on HP in total because you get the PC business. Now, as you separate these businesses, your options are open. If someone wants to come in and buy your HP enterprise, they can do it. If someone wanted to buy the HP PC, they could do it. They're separate businesses, gives you flexibility.
But other financial analysts are skeptical. They remind investors that HP's business lines are challenged for growth and face real long-term headwinds. Whether this spinoff can address those concerns and unlock value is the open question. Josh Lipton, Nightly Business Report, Silicon Valley.
It didn't get as much attention, but not to be left out. Liberty Interactive also announced plans to split into two separate companies after a late Friday board meeting. One company will consist of its popular cable shopping channel QVC Group. The other will focus on e-commerce. Shares of Liberty Interactive up more than 6% in today's trade.
Well, the Hewlett-Packard split is putting pressure on some other big companies to break up for the benefit of shareholders. Dominic Chu takes a look at which firms could be next to spin off a division.
Sometimes investors think that bigger and more diverse companies are better off as separate entities rather than joined together. And when they say better off, they mean a higher stock price.
Companies do this often because, one part of their business, it might be a part of their business that they pioneered. has become, over time, less attractive, is growing a little bit more slowly. And so to try to avoid having that part of their business continue to be sort of a drag on their more exciting part of their business, they spin it off into two parts.
On the heels of the HP and eBay separation announcements, some investors are wondering who's next. RBC Capital analyst Mark Su is suggesting that computer networking company Cisco do a similar type of thing. Food and beverage giant PepsiCo has also been the target of an activist investor, Nelson Peltz, who wants it to separate its soda from its snack food business. PepsiCo CEO Indra Nooyi has made it very clear that the company is better off with both units under the same roof. Then there's industrial giant General Electric. GE shares have underperformed the market over the last decade, and some blame the immense size and scope of all their businesses. GE has been shedding non-core units like the appliances side of things, but still has a lot of different units like energy, water, transportation, aviation, and healthcare devices. Now, the question is, will other companies also choose to take a look at separations?
So when you see major players starting to move towards, splitting up and focused is better, invariably others in the industry follow.
Investors should keep a close eye on larger companies that have lots of different business units. If the stocks do underperform, someone could step in and propose a value-enhancing move like a spin-off. For Nightly Business Report, I'm Dominic Chu.
Now, Chevron isn't splitting up, but it is selling off some assets. The oil giant and Dow component announced plans to sell a 30% stake in its Duvernay shale properties up in Canada to a Kuwaiti oil company. The price tag on that, $1.5 billion.
On Wall Street today, stocks kicked off the week on the downside as small caps resumed their sell-off. Also, investors turned a bit cautious ahead of the release of the minutes from the last Federal Reserve meeting on Wednesday and the start of earnings season later this week. The Dow fell 17 points, the Nasdaq down 20, and the S&P ended lower by 3 points.
And we have a big acquisition to tell you about in the medical sector. New Jersey-based medical device maker Becton Dickinson is paying $12 billion cash to acquire rival CareFusion. That's a San Diego-based company best known for making infusion pumps. Both companies went higher. BD rose nearly 8%, while CareFusion shot up by 23% today.
The president of the New York Federal Reserve says the U.S. economy still needs the central bank's help, but says he would be, quote, delighted to raise interest rates next year. In a radio interview, Bill Dudley said he believes the Fed should let the U.S. economy, quote, run a little hot in order to boost inflation and get more of the nation's long-term unemployed back to work. And then the Fed can begin raising rates, which he says would be a sign of economic success.
Meantime, the economic outlook for China still calls for strong growth, but not as much as previous estimates. Just today, the World Bank cut its growth forecast for China and for developing East Asian countries for the years 2014 through 2016. That forecast now calls for growth of 6.9% for this fiscal year. That's down, and next year, it's down from 7.1%. Still healthy, though, right?
But still, that modest slowdown in China is expected to be a factor in the upcoming earnings season on Wall Street. Bob Pisani takes a look at what investors will be watching for.
Earnings season starts this week, and there's good news and there's potentially some bad news. Now, the good news is that the U.S. economy is improving, and companies with a strong U.S. focus are likely to report strong results. But that's only part of the picture. The largest companies, those in the S&P 500, only get about half of their revenues in the U.S. The other half comes from places like Europe, as well as China and Latin America. Now, the concern is that while the U.S. is recovering, Europe's growth is flat at best, and some countries like Italy are again seeing negative growth. In addition to weakness in Europe, there's also concerns about a softer Chinese economy. In the past, strength in China was enough to offset disappointment in Europe. That may not be the case this time. The World Bank today said China's growth is slowing and that GDP growth will be lower this year and next. That's why there's a lot of interest in Yum Brands. They report earnings tomorrow. The company gets 53% of its revenues from China, only 23% from the U.S. So the concern is that we could have a split earnings season. Good news for smaller companies with a U.S.-based focus, but more cautious commentary from those larger companies that have operations in Europe and in Asia. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Mike Thompson says corporate America could reveal that earnings rose by as much as 10% in the third quarter. Of course, Mike is head of research and advisory services at S&P Capital IQ, and he joins us tonight. Mike, welcome back.
Hi, Bill.
So another good quarter. I mean, the expectations we have to keep saying are start high, and then they have to keep coming down, but you're looking for a pretty good quarter this time.
Oh, yeah. I think, it's funny, from October to the beginning of October to now, earnings are probably going to start moving up. But, if you look back 6 months, they were higher. They were probably just shy of 10%. So this is kind of the way the earnings expectation game is sort of played, and it cycles up. So I think you can probably expect something in 9 to 10% range when all is said and done if we have a good news scenario with earnings.
So, Mike, what's driving all that positiveness?
Well, in particular, there are three sectors that are going to lead this quarter. It's going to be the material sector, up 14%, telecoms up 11%, and healthcare. Healthcare is really becoming a solid contributor to the S&P earnings growth. They're going to be up in double digits as well. The consumer actually is having a kind of a little bit of a modest quarter, but it's such a big sector that anything 5-6% is additive. So you have a pretty good dynamic going on with the way these sectors are and the constituents work in the S&P 500. But generally what's at the core of this is that the economy is in a bit of a recovery, and that's a good news thing. And I'll underline that by talking about revenues. Revenue growth is going to come in around 4%, which after several years of really anemic top-line growth is a real breath of fresh air.
Yeah, revenues have been lagged, and companies have had to cut costs to keep that bottom line growing there at the same time. Alcoa, per tradition, starts the parade tomorrow by reporting earnings. They're not the bellwether that they used to be, but what can we learn from Alcoa's earnings for this earnings season?
It's really interesting, but I think Alcoa is actually well positioned. I think the numbers I saw is last year did 11 cents. I think the expectation is for them to do 22 cents this quarter. I think you'll see demand, strengthen their top line, and I think what you'll see is potentially improvement now, or at least beginnings of improvement, and maybe some positive comments perhaps out of their management team. Largely because commodities, the aggregate that goes into their finished good, there's some favorable currents there for them as commodities continue to go down in price.
You heard, Mike, our report from Bob Pisani talking about some of the themes, especially about China. I mean, what do you expect to hear from CEOs in the conference calls with analysts after the numbers come out about the quarter past, third quarter, and the current quarter looking ahead?
I think I don't think China is going to be a big problem in terms of what you're going to hear in terms of verbiage out of the CEOs from S&P 500 companies. I think you're going to have a lot of conversations and questions around a dollar that's improved in terms of price against other currencies, and I guess the threat of interest rates going up, right? But I think with China, in a lot of ways, the benefit is not always, with exceptions to certain companies, a lot of the benefit to the U.S. economy is actually as a producer an advantage, because what happens is their costs may be advantage in that if there's a softening, there'll be more competition amongst manufacturers for American companies to provide in their supply chain. So in effect, I'm not sure this is, it might be a problem for, as previously reported, Yum Brands and companies like that, which actually have a big top-line business. But I think generally it'll be a little bit more muted.
We will see. Mike, always good to see you. Thanks. Mike Thompson, the head of research and advisory services at S&P Capital IQ.
Still ahead, in court and under oath, what former Treasury Secretary Hank Paulson revealed about the bailout of AIG. That's next.
Well, as you heard, former Treasury Secretary Hank Paulson took the stand today as the second week of former AIG CEO Hank Greenberg's trial against the federal government got underway. Mr. Paulson defended Treasury's 2008 bailout of the insurance giant, saying it was needed at that time to stabilize the U.S. financial system. Mary Thompson has more tonight from Federal Claims Court in Washington, D.C.
6 years after helping engineer the government's response to the financial crisis, former Treasury Secretary Hank Paulson returning to D.C. to defend his and the government's actions in putting together what became a $182 billion bailout for the insurance giant AIG. In less than 2 hours on the stand, Paulson defending the harsher terms of AIG's bailout, saying the public saw AIG as a scapegoat for everything wrong on Wall Street. Paulson equating AIG to Citigroup, a firm set to fail without government help. The difference being, according to Paulson, Citi's failure would lead to other bank failures, whereas AIG stood alone among insurance companies. Paulson said AIG's tough terms were needed to get a reluctant Congress and an angry American public to buy into an AIG bailout and to pave the way for the delivery of $350 billion in TARP money Paulson says he needed to help other firms. Paulson claiming his first priority during the crisis was always to maintain financial stability. AIG's former CEO Hank Greenberg and his investment firm Star International alleging the government cheated AIG shareholders by violating their Fifth Amendment rights. This by charging unusually high interest rates on loans and failing to pursue other options to save the company. To that end, Greenberg's lawyer David Boies questioned Paulson at length about interest shown by Chinese investors in AIG at the time. Paulson, who says he was constantly engaged with the Chinese, said, "I was 100% certain the Chinese would not come in and make an investment of the size needed to save the company. Without assurances, I couldn't give." Paulson was on the stand about 4 hours less than expected, causing a scramble in the courtroom when he was dismissed. Paulson's successor, Timothy Geithner, who ran the New York Federal Reserve at the time, is the next key witness to take the stand, followed by former Federal Reserve Chairman Ben Bernanke on Wednesday and Thursday morning. In Washington, D.C., I'm Mary Thompson for Nightly Business Report.
Walmart will soon be helping customers choose a health insurance plan. The world's biggest retailer is teaming up with DirectHealth.com to put agents inside Walmart stores to help shoppers compare various private insurance plans, as well as Medicare and Medicaid. The goal is to help them pick one that best suits their needs and their budget.
We begin tonight's market focus with an update on the Ebola crisis. The Food and Drug Administration has now authorized an experimental drug made by a company called Chimerix for use as an emergency treatment against the virus. Now, that drug is being used to treat Thomas Duncan. He's the man hospitalized in Dallas with Ebola. Shares of Chimerix continued to rise throughout the day as word got out about this. It finished up about 4.5% at $31.47. Meanwhile, H&R Block's plans to sell its banking business have been delayed, sending those shares lower. The tax preparer said that regulatory approval to sell its banking unit to B of I Federal Bank is not going to go through this year. So that means H&R Block will continue to offer financial services through the coming tax season. And as a result, shares fell by 5.5% today to $29.91. And shares of Dorado Therapeutics soared after activists said that it would buy the company for $675 million. The move will help Actavis, which is a specialty pharmaceutical company, bolster its infectious disease portfolio. Shares of Dorado up almost 75% to $24.24. Actavis fell almost 1% to $243.95.
Disney and Time Warner's Turner Broadcasting both inked contracts with the NBA. Both companies have a new 9-year deal with the NBA under which their channels will be able to televise games starting with the 2016 season running all the way through year 2025. Disney shares rose slightly to $88.56. Time Warner shares were down 1% to $73.82. After the bell, the Container Store posted weaker than expected second quarter revenue. The retailer's sales also slipped below forecasts, and its outlook for the year disappointed investors. After hours, the stock initially fell. During the regular session, shares were off almost 4% to $21.89. And GT Advanced Technologies plunged today after a surprise filing for bankruptcy. The company makes sapphire glass, which was once speculated to be a component of the newly released iPhone. But the stock tumbled last month after Apple said it would not use the sapphire screens in its new devices. Today, GE stock plummeted. This is one time where you can really say that, falling more than 92% to under $1. John Fort has more.
It's a rough day for GT Advanced Technologies, a company that makes what's called sapphire glass, an extra hard type of glass that actually a number of companies, including Apple, trying to use on the Touch ID button of its iPhones and also on certain Apple Watch models. Apple has backed this company, GT Advanced, with some advanced payments like loans for them to be able to outfit a factory in Arizona with equipment to produce more sapphire glass. This company now saying they're moving into a Chapter 11 bankruptcy. Earlier filings from GT Advanced said that they were having trouble producing the amount of sapphire glass that they thought they would be able to under agreements with Apple. As far as Apple itself is concerned, it's important to point out none of what GT Advanced has produced thus far is actually going into any Apple products that are in production. My understanding is that GT Advance's production might not actually go into any Apple Watches either. Apple is known to have other suppliers for sapphire glass as well. But right now, a rough trade for GT Advanced as they try to go into Chapter 11 bankruptcy and get production up of sapphire glass. For Nightly Business Report, I'm John Fort.
Well, you may want to start thinking about drinking tea if that cup of Morning Joe starts getting too expensive. A severe drought in the largest coffee-growing region of Brazil has sent the price of coffee beans to a fresh 2.5-year high, nearly double what prices were a year ago. Experts are already concerned about how those weakened trees are going to fare next season as well.
At least gas prices are going down. GasBuddy.com reports that 10% of all U.S. gas stations are now selling regular gasoline for under $3 a gallon. The states with the lowest prices include South Carolina, Oklahoma, and Illinois, and in St. Louis, gas is the cheapest, now $2.95 a gallon on average. No such luck in Honolulu, though. Gas prices there are the highest in the nation, averaging over $4 a gallon.
I paid $2.97 this morning. I was thrilled. Coming up, an iconic New York City landmark has a new claim to fame. It is now the most expensive hotel ever sold. That story next.
A luxurious landmark hotel in New York City is changing hands as more cash-rich foreign investors pour money into U.S. hospitality properties. Robert Frank has more.
Flood capital from China has found a new place to stay in New York, the Waldorf Astoria. Chinese insurance giant Anbang buying the iconic hotel for $1.95 billion. That makes it the most expensive single hotel ever sold in the U.S. and it works out to be about $1.4 million per room key. Hilton will continue to operate the hotel for 100 years, but Anbang will invest in the hotel's renovations. It's all part of a flood of foreign money buying up U.S. commercial real estate.
Money is flowing over to the United States. A lot of it's considered flight capital, looking for safety, and the United States is the safest place on the planet to invest.
Chinese companies are quickly buying up hotels and commercial real estate around New York. Soho China bought a 40% stake in the GM building for $700 million last May. And Dalian Wanda is putting $1 billion into a new luxury hotel project here in Manhattan. But it's not just money from China. 2 years ago, an Indian investment group bought a controlling stake in another iconic New York hotel, the Plaza, for around $500 million.
So for their $2 billion, Anbang Insurance gets this, one of the trophy properties in all of New York. And they get a full square block of real estate in the heart of Midtown Manhattan.
And while this purchase marks a new peak for Chinese buyers of hotels, the question now some are asking is whether or not this peak is a bubble. Robert Frank, Nightly Business Report.
Finally tonight, who will be instrumental in shaping the future of business and finance over the next 25 years? CNBC, which produces this program, has put together a list of individuals who are at the forefront of the changes that could define the business landscape for years to come. We're calling it the Next List. This follows CNBC's earlier look at the people who have had the greatest influence and sparked the biggest changes over the past 25 years. Steve Jobs, by the way, came in at #1 on that list. Although the next list isn't ranked, it does include some familiar names like Alibaba's Jack Ma, Tim Cook, the current CEO of Apple, hedge fund billionaire Bill Ackman, Sheryl Sandberg of Facebook, and Tesla's Elon Musk. There's also some not-so-familiar names, people like MasterCard CEO Ajay Banga, co-president of the Carlyle Group Mike Kavanaugh, Daniel Ek, the founder and CEO of Spotify, and Uber founder Travis Kalanick, and the CEO of SolarCity, Lyndon Rive. Some names that you'll want to pay attention to in the future. You can find the full list of future movers, shakers, and power players on our website, of course, at nbr.com.
And some of those names that aren't familiar now, I bet you they're just going to roll off people's tongues. They're going to be as well known as Steve Jobs.
It's only a matter of time, absolutely.
That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for joining us.
I'm Bill Griffith. Have a great evening, everybody. We'll see you tomorrow.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. Tech giant Hewlett-Packard is splitting into two companies, one to focus on personal computers and printers, the other on corporate IT and technology services like data storage, servers, and software. HP shares rose about 5% today. On Wall Street, stocks kicked off the week on the downside ahead of the new earnings season. The Dow fell 17 points, the Nasdaq down 20, the S&P ended lower by 3 points. Walmart is teaming up with DirectHealth.com to help shoppers research and select a health insurance plan. And luxury women's shoemaker Jimmy Choo will begin selling shares on the London Stock Exchange. New York City's landmark Waldorf Astoria hotel was sold to a Chinese insurance company for $2 billion. Be sure to tune into Nightly Business Report right here on your public television station.